I turned $18 million into $14 billion in 13 years. But here's what nobody tells you. The same principles that built that fortune can destroy your retirement if you apply them wrong after 50. I'm Peter Lynch, and I managed Fidelity's Magellan Fund through some of the wildest decades in market history. Today, I'm going to tell you something that might save your financial life. Let me be direct. If you're over 50 and still investing like you're 30, you're playing Russian roulette with your retirement. I've watched countless brilliant people with impressive careers torch their nest eggs in their final working years. Not because they weren't smart, but because they forgot one fundamental truth. The game changes when time stops being on your side. Here's my number one investment tip for those over 50. Invest in what you know, but more importantly, know what you can afford to lose. When you're young, ignorance is expensive but recoverable. When you're older, ignorance is catastrophic. Let me explain what I mean. During my years at Fidelity, I popularized the idea of investing in what you know. Shop at a great store? Buy the stock. Love a product? Research the company. That philosophy helped everyday investors beat Wall Street professionals who were too busy reading reports to notice what was selling in the real world. But here's the crucial part most people miss. That advice was designed for people building wealth over decades, not protecting it in their final stretch. At 50 plus, you need a different lens. You're not just asking, is this a good company? You're asking, can I afford to be wrong about this for 5 years? The difference is everything. I remember meeting a teacher in Boston back in 1995. She was 53, had been teaching for 30 years, and had finally built up a decent nest egg of about $200,000. She came to one of my talks and heard me say, invest in what you know. 2 months later, she called to thank me. She'd put everything into a tech startup her nephew was involved in. It's going to be the next Microsoft, she told me, breathless with excitement. By 1997, the company was bankrupt. She worked until she was 72, not by choice. That story haunts me because I know my advice, taken without nuance, contributed to her disaster. The lesson isn't that you shouldn't invest in what you know. It's that after 50, you need to pair knowledge with something even more critical: margin of safety. When I was running Magellan, I could take big swings. A few would strike out, but the home runs more than made up for it. I had time. The fund had time. Investors had time. If I was wrong about a company for 3 years, we could wait for year 4 and 5. You don't have that luxury anymore. Let me tell you about the single biggest mistake I see people over 50 make. They confuse familiarity with understanding. They think because they use Amazon every day, they understand Amazon's business model, competitive moats, debt structure, and long-term risks. They don't. I spent 60 to 80 hours a week researching companies. I visited factories. I talked to competitors. I analyzed balance sheets until my eyes bled. And even then, I was wrong about 40% of the time. The difference is I had dozens of positions and decades of compounding to smooth out my errors. When you're over 50 with limited capital and limited time, you can't afford my error rate. You need to be more selective than I ever was. So here's what invest in what you know really means after 50. It means invest in boring, predictable businesses where your knowledge actually gives you an edge. Not edge in finding the next 10-bagger. Edge in avoiding the next Enron. You work in healthcare? You probably have insight into which pharmaceutical companies have sustainable competitive advantages. You've been a retail manager for 30 years? You understand which chains have real customer loyalty versus which ones are slowly dying. But here's the critical part. Use that knowledge defensively, not offensively. When I was at Fidelity, I loved finding small companies that could grow 50-fold. I'd dig through the footnotes of obscure industrial reports looking for hidden gems. That made sense when I was 35 with a 30-year career ahead of me. At 50 plus, you should be doing the opposite. Use your knowledge to identify what not to own. Your experience isn't about finding lottery tickets, it's about avoiding landmines. Let me give you a framework I wish I'd emphasized more clearly back in my fund managing days. I call it the sleep test. After you buy a stock, can you sleep soundly if it drops 30% and stays there for 2 years? If the answer is no, you own too much of it. At 30, volatility is your friend. You can buy more at lower prices and let time heal all wounds. At 60, volatility is your enemy. You might need that money before the market recovers. Or worse, you might panic and sell at the bottom, locking in permanent losses. I've always said the real key to making money in stocks is not getting scared out of them. But being scared means something very different when you're 55 versus 25. At 25, scared means you sell and miss the rebound. At 55, scared means you can't pay your mortgage. That's why after 50, your portfolio construction matters as much as your stock selection. Maybe more. Here's how I'd invest if I were starting over at 50 today. And I mean this literally. If I had to rebuild a retirement portfolio from scratch with 15 years until I needed the income. First, I'd accept that I'm not going to hit home runs anymore. I'm going for base hits and walks. Singles and doubles win the retirement game. Swing for the fences, and you'll strike out when it matters most. That means my core portfolio, maybe 70% of it, goes into companies so boring they'd put you to sleep. Coca-Cola, Johnson & Johnson, Procter & Gamble. The same stocks that were boring when I was running Magellan and are still boring today. You know why they're boring? Because they just keep making money year after year after year. The remaining 30%, that's where you can use your specific knowledge to find better opportunities. But even here, you need guardrails. Only invest in companies where you genuinely understand the business model. They have strong balance sheets with manageable debt. They've been profitable for at least 5 years. And you can explain in one paragraph why they'll still be relevant in 10 years. If you can't check all 4 boxes, walk away. Let me tell you about a mistake I made that cost me personally. In the late 1990s, I knew e-commerce was going to be huge. I could see it. So I bought a basket of .com stocks with my personal money, not the fund's money, mine. By 2002, most of those positions were worthless. I was in my 50s at that point. Yes, I'd made enough money at Fidelity that it wasn't devastating, but it was humbling. I'd violated my own principles because I got excited instead of staying disciplined. The painful truth? If I'd just put that same money into the boring index fund I recommended to my mother, I'd have been far better off. Sometimes the teacher needs to follow his own lesson plan. Here's what I learned from that expensive education. After 50, excitement is not your friend. Excitement is usually the market's way of separating you from your money. The most dangerous words in investing are, "This time it's different." People said that about railroads in the 1800s, radio in the 1920s, electronics in the 1960s, .coms in the 1990s, and housing in the 2000s. It's never different. Gravity always wins. When you're older, you need to be even more skeptical of revolutionary opportunities. Not because they can't exist, but because you can't afford to be wrong about them. Let's talk about portfolio construction in practical terms. If you're 50 today and want to retire at 65, here's what I'd recommend. You need stocks. Don't let anyone tell you to go 100% bonds at 50. That's outdated advice from an era when pensions were common and life expectancy was shorter. You'll probably live another 30 or 40 years. Bonds alone won't cut it. But the stocks you own need to be carefully chosen. Divide your equity allocation into 3 buckets. Bucket 1 is your foundation, 50% of your stock allocation. These are the bulletproof companies. Think about businesses that would survive a depression. They sell products people need, not want. They have fortress balance sheets. They've paid dividends for 50 years and raised them every year. Bucket 2 is your income generator, 30% of your stock allocation. These are solid companies with high dividend yields. Utilities, REITs, telecommunications, boring, steady, cash-flowing businesses. You reinvest these dividends now and they become your income stream later. Bucket 3 is your growth sleeve, 20% of your stock allocation. This is where you can use your specific industry knowledge to find better opportunities. But remember the 4-box test I mentioned earlier. Every position in this bucket needs to pass all 4 criteria. The remaining allocation? A mix of bonds and cash appropriate to your situation. If you're 50, maybe 30% bonds and cash. If you're 60, maybe 40%. The older you get, the more you shift towards stability. But here's the key insight that most people miss. It's not just about the allocation. It's about the sequence of returns. The 5 years before you retire and the 5 years after are the most critical of your entire investing life. A bear market during those years can devastate your retirement in a way that no amount of gains in your 30s and 40s can offset. Let me illustrate. Imagine two investors, both 60 years old, both with $500,000. Investor A experiences strong returns from 60 to 65, then a bear market from 65 to 70. Investor B experiences a bear market from 60 to 65, then strong returns from 65 to 70. Even if the average returns are identical, Investor A will have dramatically more money at 70 than Investor B. Why? Because Investor B had to withdraw money during the bear market, selling assets at depressed prices and permanently reducing their capital base. This is why the invest in what you know advice needs modification after 50. You're not just trying to maximize returns anymore. You're trying to manage sequence risk. If you're behind on retirement savings at 55, the solution isn't riskier investments. It's a combination of working longer, spending less, and making sure the investments you do have are protected from catastrophic loss. I know that's not exciting advice, but I've never seen anyone get excited their way into a secure retirement. I've seen plenty of people get excited their way into financial disaster. Let me address something I hear constantly. But Peter, you took big risks. You bought unknown companies. You bet big when you had conviction. Shouldn't I do the same? Here's what people forget. When I took those risks, I was taking them with other people's money in a diversified fund structure with liquidity provisions and professional risk management. That's completely different from taking risks with your own retirement savings in your late 50s. Also, I was wrong a lot. I've never hidden that fact. I estimated that 6 out of 10 of my stock picks were average or worse, 3 out of 10 were good, and 1 out of 10 was a home run that made up for all the mistakes. That ratio works beautifully when you have 100 positions and unlimited time. It's disastrous when you have 10 positions in 10 years. So when I tell you to invest in what you know after 50, I'm really telling you to invest in what you know won't blow up. That's a very different thing from investing in what you hope will explode higher. Here's another critical point. Knowing a company's products is different from knowing if it's a good investment. I love the food at many restaurants. That didn't make them good stocks. Most restaurant chains are terrible investments. High capital requirements, low margins, brutal competition, and changing consumer tastes. So your knowledge needs to extend beyond I like this product to I understand why this company will be profitable for the next decade. That requires homework. Real homework. Reading annual reports. Understanding the balance sheet. Knowing the competitive landscape. If you're not willing to do that homework, and most people aren't, then you should stick with index funds and boring blue chips. There's no shame in that. In fact, it's the smart move for 90% of investors at any age. Here's what to look for in a stock after 50. Consistent profitability, not just growth. Growth is nice, but profitability is essential. Low debt, this is non-negotiable. High debt turns good businesses into risky bets. Competitive advantages that you can identify and explain. Why will this company still be relevant in 10 years? And reasonable valuation. Don't overpay for even great companies. Let me give you some examples. Done right. You've worked in the pharmaceutical industry for 30 years. You understand which companies have strong drug pipelines. You identify 3 companies with durable competitive positions and reasonable valuations. You split your growth allocation among them. Done wrong. You've used Apple products for years and love them. You put 40% of your retirement savings into Apple stock because everyone uses iPhones. You haven't read the annual report. You don't know the debt load. You just know you like the products. See the difference? One is informed investing based on genuine expertise. The other is gambling based on consumer preference. The hardest part of investing isn't buying, it's holding. And after 50, it becomes even harder because you're more aware of the finish line. Every downturn feels more threatening because you know you don't have 30 years to recover. This is where emotional discipline becomes paramount. You need to build a portfolio you can hold through a bear market without panicking. Not a portfolio that looks good on paper. A portfolio that lets you sleep at night when the market drops 30%. How do you build that portfolio? By only owning things you understand and believe in, fundamentally. If you own a stock just because someone recommended it, or because it's been going up, you'll sell it the moment it goes down. But if you own Johnson & Johnson because you've researched the company, understand its diversified revenue streams, know its competitive advantages, and believe in its long-term viability, you can hold it through turbulence. Your knowledge gives you conviction. Conviction gives you staying power. Let me tell you about one more critical mistake: recency bias. People chase whatever has been working recently and assume it will continue working forever. Tech stocks crushed it in the 2010s, so people in their 50s loaded up on tech. Then interest rates rose, and many of those stocks got hammered. The lesson? What worked last decade might not work next decade. Your job isn't to predict which sector will be hot. Your job is to own businesses that will be around and profitable regardless of which sectors are fashionable. That's why I keep coming back to boring essential businesses. People will keep brushing their teeth, taking medicine, eating food, and using electricity regardless of what's trending on Wall Street. Now, let me address the elephant in the room. What if you're 50 and way behind on savings? First, don't panic and do something stupid. The worst thing you can do is try to make up for lost time by gambling on high-risk investments. That's like being behind schedule on a road trip and deciding to drive 100 miles per hour. Instead, accept reality and adjust your plan. Maybe you work until 67 instead of 65. Maybe you downsize your retirement dreams a bit. Maybe you take on a side hustle to increase savings. But whatever you do, don't abandon sound investing principles just because you're behind. Start with index funds. Build a diversified portfolio. Contribute consistently. Let time do the heavy lifting, even if you have less time than you'd like. Some wealth built on solid principles is infinitely better than no wealth built on gambling. Here's my final truth for anyone over 50. Wealth preservation matters more than wealth creation. You've spent decades building your nest egg. Don't blow it up in a final desperate attempt to get rich. The finish line is in sight. This is when you need discipline most. This is when the temptation to take shortcuts is strongest. This is when you need to remember that boring wins. Invest in what you know, but make sure you really know it. Make sure it's boring, predictable, and durable. Make sure you can hold it through tough times. And make sure it fits within a diversified portfolio designed for capital preservation first, growth second. That's not sexy advice, but it's the advice that will get you to a comfortable retirement. And at 50 plus, comfortable retirement beats exciting bankruptcy every single time. The greatest risk isn't missing out on the next Amazon, it's blowing up your nest egg on the next Enron. Invest accordingly.